As the continuing trillions of dollars in central bank intervention distort asset prices ever higher, investors are forced to make an uncomfortable choice. Do they ride this wave and risk being wiped out if it crashes? Or do they seek safety now, but risk being left behind as inflation eats away at their capital? Widely respected fund manager Dylan Grice is choosing to stay in the game. But like many investors today, he hates how dangerous it's become to do so.
Bullish, implies it's a kind of good. I think they're going up. I think they're going higher. And I think, valuations are going to look even more crazy. But I don't think it's a good thing, and it's not something that I'm particularly, happy about. It scares me a bit, actually.
Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, welcoming you back for another week of making sense of money and the markets so that you can make better informed decisions about building your wealth. Now, the majority of recent experts we've interviewed on this program have been extremely skeptical of today's record high market valuations, and most of them predict a painful market correction lies ahead in the coming months. This is why one of the more common comments I receive is, can you bring on someone who has a bullish outlook on the markets? Well, absolutely. In fact, I'll do that right now in this video. But as they say, be careful what you wish for, as his reasons for expecting even higher prices from here aren't happy ones. Please join me in welcoming fund manager Dylan Grice to the program. Dylan is co-founder of Calderwood Capital and the author of the highly respected macro research publication, Popular Delusions. Dylan, thank you so much for joining us today, all the way from the UK.
Great to be here. Thanks for having me, Adam.
Great. Well, look, so many questions for you, but I want to start at the top. Before introducing any potential biases into this conversation, can you just give us a sense of your current assessment of today's global economy and financial markets?
Hot. I think, everywhere you look, there's kind of signs of froth. I think it doesn't matter which market you look at, just about. I think spreads are phenomenally tight. Covenants are phenomenally weak. Lending attitudes are very accommodative. Venture valuations are very high. Private equity deals are very enormous, et cetera, et cetera. So, we're clearly, I think we have very overheated financial markets. And, these are the kind of markets that they're kind of fun while they last. And they will, these excesses will kind of have a cost. But, I'm sure about that.
All right. Well, let's continue the hot temperature related analogies here. So earlier this year, you called yourself a reluctant bull. And I think you did that, and correct me if any of this is wrong, but back then you had said that the markets had become quote unquote incredibly frothy, but you felt that you needed to remain bullish because, quote, the central banks will overcook the markets. So my question for you, given what you just said, is the meal crispy enough at this time? Or do you think that the central banks are going to continue bringing the heat for a while longer?
No, I actually feel that the risk is still very much on the right tail. I feel that, the Jackson Hole speech that Jerome Powell just gave, he talked about tapering, but he also made very clear that interest rates were going to kind of stay at zero until, he said, until we reach maximum employment, full employment, and until inflation is sustainably higher than 2%, right? So there's a period of sustainable inflation greater than 2%. So I feel that that's a kind of recipe for disaster, really. And it feels that that's a mistake that's been made, a number of times in history. And that mistake is that when you run the economy really with a kind of an exclusive focus on the CPI. and you're kind of blind to other signs of overheating. Nobody, pilots don't fly an airplane just looking at one measure. You don't drive your car just fixated on one measure. I think it's incredibly stupid to run the economy fixated on one measure. And people that have done it in the past, when central banks have done this in the past, they've ultimately screwed it up. The very first episode of running an economy far too hot because you were misled by the quiescence of the CPI was actually the 1920s. It was the Federal Reserve, and that led to the bubble in the late 20s, which of course led to the Great Depression, or was one of the triggering events of the Great Depression. It wasn't quite as simple as a stock market crash, therefore Great Depression, but it set in sequence a series of mistakes, really. But the biggest mistake, to my mind, was allowing the thing to overheat in the first place. And the reason they allowed it to overheat in the first place was because they had the blinkers on. They were looking at the CPI. And since then, you've had Japan in the 80s, right? That was exactly the same phenomenon. They didn't see they turned a blind eye to the overheating in real estate and the stock market because inflation was so low. So they thought, well, there's no inflation because the CPI is actually quite well behaved. So there's nothing to worry about it. And of course, that was catastrophically wrong. All the Asian economies in the late 90s did exactly the same thing. Alan Greenspan did the same thing also in the late 90s with the tech bubble. Ben Bernanke did it a few years later, right, with the housing bubble and the subprime crisis. So I think this is kind of a well-trodden path. And when Jerome Powell says, I don't have anything to worry about as long as the CPI is quiescent, for me, that just sets off alarm bells. And so I just feel that this froth is just going to build and build, and we're probably going to look at looking at another bubble. So that's why it was kind of, I said it was kind of, an answer to the question, are you bullish of risk assets here? Then, as I said, bullish, implies it's a kind of good. I think they're going up. I think they're going higher. And I think valuations are going to look even more crazy. But I don't think it's a good thing, and it's not something that I'm particularly, happy about. It scares me a bit, actually.
Okay, very well put, and consistent with a number of the experts that we've had on this program recently. So I'm going to sort of state what I can see sort of as their consensus view, and you tell me if you agree or disagree. But they do see a period of sort of continued. I mean, some see a true melt up coming, but a period of continued upward pressure on prices as this all this central bank overstimulus reaches its apex. Then to be followed by some sort of reckoning. Some people see that as a correction. Some people just see it as crushing inflation that forces the Fed to have to start raising rates. Whatever that's going to be. So sounds like you're seeing something similar, right? Where you're like the train is already on a runaway course. It's got a ton of momentum behind it. Doesn't look like the engineers driving it are going to slow it down willingly. But you just don't see it being able to continue sustainably on that course for all that much longer. And that when it does hit its reckoning, it's not going to be fun for anyone. Is that all accurate?
Well, I'm not sure I agree with all of that. The problem I have with inflation, of the CPI variety, because I think the asset inflation I think is pretty kind of clear. And it's pretty clear what the source of that asset inflation is. The real inflation is in the bond market. That's where the price distortion is. That's where prices are too high, right? Bond prices are far too high. Real yields are far too low. And that just ripples out across the entire spectrum. All assets are commensurately overvalued in the way that the bond market is overvalued. So that's what causes this kind of widespread asset inflation.
All right, and I'm sorry to interrupt there, Dylan, but is that because basically, there's another way of stating that is that debt is just becoming way too cheap, and so people are using that debt to drive up asset prices of all types and kinds?
It's because debt, borrowing is becoming too cheap. Yes,
Yeah.
right. So this is why you get. I think this is where the excesses come from, right? So this is why you're seeing, ever growing PE deals. I think this is why you're seeing higher private market valuations. It's certainly why you're seeing higher equity valuations. Equities are real assets. They're discounted by a real interest rate, by a real discount rate. And that real rate has been pushed into negative territory. Implicitly, I don't think they've gone out to target negative real interest rates, but implicitly, by targeting such a low nominal interest rate, with inflation expectations, roughly at 2%, because CPI inflation is roughly at 2%, that just leaves real interest rates as the variable that has to adjust. So the effects of the Fed effectively keeping, I think we're already in a kind of yield control, a kind of quasi yield control type environment. The effect of keeping nominal yields artificially low is that real yields get depressed. And that actually just the valuation arithmetic is that pushes everything else up, right? So it's not just about the cost of borrowing, right? Before you get to that, you just the valuation arithmetic is if you've got negative real yield, you're going to have much higher equity valuations, right? If you've got very low nominal rates, you're going to have much lower costs of borrowing, right, for a given credit risk premium in the credit markets, and so you see that very, very clearly. In terms of the flip side, if you're a triple C company, you've probably got, I think, triple C companies have got like a 50% chance of defaulting over the next 10 years, right? You're borrowing at 6%. You're barely creditworthy, and you're borrowing at 6%. So of course, that just leads to excesses and a misallocation of capital, and so to your point, it's these excesses that ultimately lead to a kind of deflationary bust. So I don't know about inflation, CPI inflation. To get back to your question, I do understand the arguments, and I do find myself feeling very unnerved by some of the policies that I see, and some of the kind of normalized actions that would have been kind of breathtaking 20 years ago. But this kind of MMT world that we're in, I find quite disconcerting. But I was worried about those things 10 years ago, and look where we are. So I don't quite know where the tipping point is. And so it's not clear to me that we suddenly get this, massive inflation. By the way, I'm not saying that I'm relaxed about it, and I don't think there's going to be a huge inflation problem. I'm just saying that maybe there won't be, right? For all the reasons that we've been wrong, or guys like me have been wrong for the last 10 years, we'll be wrong for another 10 years, So I kind of am quite agnostic on that particular aspect of it.
Yeah, well, it just sounds like humility to me. There's a lot of people that have watched this market do what they didn't think it could do for much longer than they thought it could do. And so, in many ways, I think the sane, rational thing is to take the position you're saying, which is, hey, look, this is what I think may happen, but we don't really know. And so as somebody who manages capital, I want to get into this a little bit later in the interview.
Yeah,
I'm curious, what steps you're taking, because you kind of have to pick a course, but you also have to put in some insurance or defenses in case your primary thesis, continues not to be exactly what reality is. Before we get there, though, I want to, two questions for you. First, again, asking you to put on your prognosticating goggles. We've been talking a bit about inflation. So
the ones that don't work, but you'll ask me anyway, and I'll answer anyway.
Okay, no worries.
We'll pretend we do.
So inflation, stagflation, disinflation, deflation. Which inflation do you think we're most likely to experience, over the near to midterm from here, or maybe it's a progression of inflations? Do you have any strong opinion?
What's the medium term? Give me some years. Is that like 3 years?
Let's say the next 6 to 9 months.
Oh, 6 to 9 months. I think probably disinflation on a CPI basis.
Okay. And for folks watching who don't know what disinflation is, it means you still have you still have growth. It's just your rate of growth is diminishing.
the rate of inflation declines, but you still have inflation.
It's still positive, but it's declining. Yeah,
and I think you'll get that just with base effects. You know, you will start to see that as you kind of have as these things kind of start to unwind. And I do, for what it's worth, you know, I think that the trend for kind of durable goods inflation is still negative. You know, and that has been the trend, not for decades. And I think there's good reasons for that. And I think that's going to continue. So, and I hate to say it. Well, I don't hate to say it, but it's an unusual position to find myself in. But I do kind of agree with what, most of the kind of central bankers are saying right now on inflation. And, that it's transitory. I think that if you look at the inflation markets, they've actually been quite relaxed throughout the whole episode, and the way you see that is not by looking at 5-year inflation expectations or 2-year inflation expectations. We're looking at the difference between 10 and 5, or looking at the difference between 30 and 5, and what you find is that inflation curve is massively inverted. So the inflation market is telling you, rightly or wrongly, but the inflation market is saying, hey, we're relaxed. We're kind of relaxed here. We don't think that there's anything to worry about long term.
We're not that nervous about it. Yeah.
And by the way, I'm not sure on a 30-year view. 30 years is a hell of a long time. So for kind of 30-year inflation break-evens to be where they are is, I don't think that's very attractive. Real yields to be basically zero on 30 years, I think, is a very, very unattractive prospect. But yeah, for what it's worth, I think that the inflation markets have been have not questioned the Fed's credibility, and on this particular issue, I don't think that inflation is going to blow off over the next 12 months.
Okay, great. Well, look, I want to talk to just a fundamental reason for the existence of central banking, which is issuing sovereign currency. And on that topic, I want to just read a tweet here that you just recently put out. Independence of currency issuance is as essential to democracy as independence of the judiciary. It's not that central banks should be independent, it's that they should be abolished. Currency issuance should be constitutionally denationalized. Can you explain your position here? And can you also clarify what you mean by a constitutionally denationalized currency? Yeah, God. When did I write that? Yeah, about a month ago. Yeah, that's right. No, I do remember it. I just, when you read it back to me, it sounds like there's a lot in that. So what do I mean by that? I guess I think that how to summarize the ultimate source of I think government power. One of the ultimate sources of government power is or state power is the printing press. Right, the ability to issue currency, seigniorage is I mean, it's difficult to understate really how significant, how much power that grants them. I mean, if you consider this mess in Afghanistan, which, by the way, people who have been talking about Afghanistan being a mess, at one end of the spectrum, they've been called, basically, they've all been cranks, right? Basically, anyone who, if you were at the right end of the spectrum, you were just unpatriotic, right? If you were American, you were unpatriotic. If you were at the wrong end, you went to jail, right? That's the way people have been who raised questions about what was going on in Afghanistan have been treated. And if you were American. And if you weren't American, you just obviously hated America, right? Or you were jealous of American greatness, all right? You had this very strangely kind of irrational environment where you couldn't really have much of a conversation about it. Now, all of a sudden, it's a disaster, and everyone knows it was always a disaster. And what the hell would we do about it? Now, suppose you'd have been, like, people had been asked to raise
People had been asked to pay a surcharge on their tax, on their income tax, to fund this war in Afghanistan. Actually, not just to fund this war in Afghanistan, but to fund the war in Iraq and to fund the NSA surveillance program, etc. Suppose that you had line items on your tax statement and you could opt out of those ones that you didn't like, right? How many people do you think would have actually opted to pay tax to fund a war in Afghanistan?
Right,
or
a lot fewer.
Right. By the way, not very, I would have thought, not very many, right? So how much does the war in Afghanistan cost? I think kind of estimates vary, but you're probably talking about $1 trillion. How much is the Fed printed as part of its QE program? Kind of 3 to 4 trillion from memory. I don't know, you can Google and get the answer of, the actual answer, 3 to 4 trillion. So I think there's a very strong argument that the Fed funded Afghanistan, right? And I feel that that's argument, and of course it would fund Afghanistan, because you said the purpose of central bank was to issue fiat currency. Because the purpose of central banks, if you go back to the origins of central banking, and I'm talking about the Bank of England specifically, but if you look at even the creation of the Federal Reserve, the prior legislation for the Federal Reserve, which was really enacted in which centralized the banking system in America, which was really enacted during the Civil War, the purpose was to fund government. That's what the purpose of central banking was, to fund government. There was nothing to do with price stability, certainly nothing to do with financial stability. It was to fund government. And so the reason I wrote that tweet was because I'd been reading about the American Civil War and the end of the free banking era. And it kind of occurred to me that the reason, because before the Civil War, America had from 1837 until about 1861, 1862, America had completely free banking. And the reason it was crushed, and which it was, from a legislative perspective, it was completely crushed, was because a system of free banking wouldn't have funded the war effort, right? And again, where you stand in the Civil War, and which is an incredibly controversial topic still, that's not really what I want to get into, but. Although if you find it interesting, we can do. But the astonishing thing to me was that it was basically set up to fund a war effort. And if you look at the First World War, it was exactly the same thing. All central banks of all participants funded the First World War by printing money, right? And catastrophically, the Germans, who lost, and then had to pay reparations with printed money. But again, it all comes back to the central banks and governments being able to coerce central banks into funding their desires, which frequently are the making of war. So it was really just to try and isolate just how important a source of power politicized currency issue actually is. So that's kind of what I was getting at. And I think that the other reason why the government has huge power is because the government can legislate, right? And so the reason why we have an independent judiciary, which goes all the way back to Magna Carta, is because the government should be a part of the legal system. It shouldn't be above it. And when you get into countries like Russia or China, the government basically just weaponize the legal system against their enemies, right? So most people who believe in democracy and believe that citizens should be sovereign believe that the judiciary should be completely independent from the executive. And all I was saying was, well, if you actually look a little bit deeper into most of the kind of catastrophic events, in recent history, most of the big wars, they've basically been funded by central banks, right? So if you really, we've got involved in these conflicts that most people didn't want to be involved with, right? The government could do it because government could print the money, therefore government could fund it. So that was basically the thinking. Is it such a bad idea to completely eliminate central banks as a constitutional point. So listen, we're never going down this path again, because ultimately, independent money is a check on power.
Well, so I think that's such a fascinating point, and we have a lot of discussions on this program about the roles of the central banks. And I think, to be honest, I think I'd say the culpability of the central banks in a lot of the ills that we're dealing with right now. And certainly you brought up kind of the funding of the war machine, but you could also just look at, anything from the devaluation of people's purchasing power here, the rock bottom interest rates that have basically just declared war on savers, or people that need to live off a fixed income in their old age. And certainly, you can make arguments one side or the other, but if you look at our policy responses to both the global financial crisis and then again to the coronavirus pandemic, the actions of the world's central banks, I think, have at this point pretty irrefutably led to tremendous acceleration in wealth inequality. Right. So there's all these different reasons why I think we can look and say, look, the current way in which the central banks operate isn't necessarily in the best interests of the general public. There may be more in the best interests of the people running the system, whether it's the institutions themselves or the people who benefit the most from these policies. So anyways, there's I think lots of reasons to try to imagine a different model. Yeah. Well, look, I want to get to what you have to do on a daily basis, right? Which is you have to sort of take all these factors into consideration, both what the institutions are doing, but also, mapping all the soft, elements in here in terms of the human factor and, the power dynamics and all that stuff.
I mean, to be honest, most of what we've been talking about so far, none of that figures at all. I don't factor any of that stuff in to what we do in the portfolio. I just find it very interesting. Right. And I kind of enjoy toying with some of these ideas and playing with some of these ideas. And, but in terms of the practicalities of managing money and managing capital, I'm not really sure how practical any of the previous 45 minutes.
Well, I think one practical point could be, and you correct me if you disagree, but it sounds like given everything we just talked about, it's pretty easy to come to the conclusion that the central banks are going to continue to print and continue their current policies for as long as they can more or less get away with it without the system, breaking underneath them. And so as you look at where asset prices are going, like you said earlier, in a rational world, maybe they should be a lot lower, but they might not be for a while, given all this sort of artificial support that the central banking system is giving to them.
Yeah, well, I mean, I think that, yes, I agree with all of that. I would also kind of just, to bring it back to us, to the valuation and stock markets, you have, or just all markets really, the actual, the spread between kind of equity yields and real treasury yields is actually bang in line with its historic norms, right? It's bang in line. So if you want to say, well, are asset markets overvalued? I think the answer is yes. But then if you look at the relative pricing of asset markets, are credit markets rich at the moment? Yes. But they're at the rich end of the historical range. They haven't really, we haven't broken new ground. So you can't say, well, this is unprecedented richness in credit pricing, because it's not unprecedented. We've been here a bunch of times before. And by the way, and it's never ended well. Okay, so I'm not trying to kind of apologize and make excuses for it. I'm not saying it's a good thing, but it's not kind of so you could say that the market pricing of risk is more kind of cyclical at the moment, relative to the risk-free rate. Look at the price of equities or the valuation of equity markets; they are kind of in line with their historic norm. So again, you would say, well, the valuation of equity markets relative to the bond market, to the real pricing of the bond market, kind of looks kind of vaguely rational. The real screw up is in the bond market, and that's what elevates the whole thing, right? So, what do you think that is going to happen to bond yields? My guess is that they probably don't let bond yield rise too high, and as soon as like the taper tantrum, whenever it was 13, If bond yields actually do start to move too quickly, they'll intervene and they'll keep them down. And so if they're going to peg bond yields lower, if inflation expectations were to rise, then that pushes real yields down even more. And if real yields go down more, then equities go up more, right? So it doesn't, and equities have in the past traded very, very richly against bonds. Right now, they're not. There's nothing at all to say equities can't just now start to trade richer against government bonds, right? I think there's lots of good reasons for equities to trade much more tight versus government bonds than they are today. For example, a friend of mine said, why do I need to bother with all this inflation protection nonsense when I can buy Google? Right, I can buy Google on a kind of free cash flow yield of like, I don't know, whatever it is, 6% growing at double digits. That's my expected return. Right, I don't really have to worry too much about it. Dominant player, dominant participant, still is likely to dominate its industry for the foreseeable future, et cetera, et cetera, et cetera. If Buffett was younger, he would be all over Google, right? He wouldn't be that interested in Coke, right? Why do I need to bother about inflation? Why not? And I think there's a very strong logic to that as an argument, right? In other words, equities, if you really, really worried about inflation, just own the really good equities. And I think that's kind of what's happening. So in that kind of scenario, why can't equities price rich against treasuries? Because they're not at the moment, right? So there's all sorts of scenarios where equities can just go so much higher than they are right now, and yes, the overall valuation will be crazy, and but relative to what? Relative to negative real yields. So if you think that the Fed are going to kind of fight tooth and nail to keep real yields roughly where they are now or even lower, it's difficult to really get too bearish about equities, in my opinion.
All right, so I want to get to the specifics of kind of how you're allocating your portfolio right now, but really quick to the point you just made. So how would you, when you look at, say, an indicator like PE ratio, historical PE ratio averages, or like the Buffett indicator, PEs are, I would say, at the very high end of the historical range, and the Buffett indicator is often in the stratosphere. I mean, it's often territory it's never been in before.
Yeah.
So for folks that kind of look at those historical valuation indicators, what would you say to them in terms of saying equities can still go a lot higher?
I feel that, what I'm about to say is probably considered heretical in many places, but I feel that it's all relative. I don't think there is such a thing as absolute return, right? If the Shiller PE ratio, into the 30s, you're probably looking at 2.5% to 3%, depending on how you calculate, 2.5% to 3% Shiller earnings yield, right? Maybe add on 1% of growth, maybe, right? And again, because the growth in the economy has not quite been matched by the growth in EPS. But anyway, add on 1% for growth, right? And be generous and say, okay, so that's 3.5% to 4% that you get your yield plus growth, right? That's your real yield. That's your real expected return. Okay, that's it. Now, is that good? Are you happy with that or not? Is that good return? Is that bad? And I would answer the question for you. If I were to give a serious answer, is a 3 or 4% real yield attractive? You say, well, it depends what I can get elsewhere. Right? It depends what you can get elsewhere.
Exactly.
If I say, well, I can actually give you, there's a distressed seller of inflation protected securities over there, and effectively selling for a 10% yield. Would you prefer that? Of course you would. Right. So it's kind of nonsensical, really, to talk about, to me, it's nonsensical to talk about the Shiller PE ratio without also talking about real yields. It doesn't make any sense to me. Right. Because you have to, if you're going to say, well, 4%, that's crazy, which it is, it's crap. It's a terrible risk adjusted return in my view. But where else are you going to go? Right. So that's, to people who kind of say, well, equities can't go higher because PEs are already low, look at where real yields are. Right, and tell me why real yields are irrelevant to where the equity market is. Tell me why.
Yeah, well, I think, and might want to tear this to shreds, but I think, most people are choosing equities right now because they feel like they've got a bayonet at their back, right? Where they can't get good return anywhere else, right?
Yeah.
And so they're just getting shoved up the risk curve, right? They're not happy about it.
Yeah.
But in many cases, they either fund managers like you feel like they have to generate some return for their clients, or retirees feel like they just got to have something to eat, right? So they go up the risk curve, but it's not something that they necessarily feel is sustainable or good.
Yeah, and I think this is why what central banks doing is so sad, really, because you're kind of forcing people you're forcing people to take risk, I kind of feel that most people who are buying equities because equities have done quite well recently. The nuance of the valuation kind of is not really a factor in most people's decision. They've gone up, so I'm buying them. So they're good, they're great. If it goes up, I'm happy. That's the logic. And the more the Fed does what it's doing and distorting these kind of prices, I think the more that type of attitude wins, right? And therefore, the more that type of attitude dominates, and that's what you're seeing. And so you suck in these kind of unsuspecting investors in a bubble, all right? And they're the ones that always get hurt, all right? So I find it kind of very ironic that the people who are talking about the absolute steadfast need for cryptocurrency regulation because we have to protect Americans, for Christ's sake, right? These are the same people who have blown a bubble in every single asset class that you can name. It's very ironic.
Well, all I can say is hallelujah, brother. Totally on the same song sheet as you there. All right. Well, look, in landing the plane here, I do want to make it as practical as possible for people. So two main last questions for you. The first one being, so given all the challenges and the smoke and everything that we're talking about here, given how hot the central banks are cranking up the heat in the oven, how are you allocating capital right now in this environment? What does look good, or at least good enough to you right now? We hope you've been enjoying this animated discussion with fund manager Dylan Grice. The interview continues over in part 2, where Dylan explains his firm's highly unconventional investing strategy, which seeks to insulate itself from many of the risks that he and I discussed in this interview. To watch part 2, just click on the link provided in the description of this video below, or go to youtube.com/Wealthion. But before you go, please don't forget to hit the like button and then click the subscribe button below if you haven't already, as well as that little bell icon right next to it. It only takes you a second, and it really does help us out, as the more subscribers that this channel has, the more big name experts we can attract onto this program in the future. Oh, and if you'd appreciate a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio with the risks that Dylan highlighted here, just go to Wealthion.com and we'll help set one up for you. Okay, I'll see you over at part 2 of our interview with Dylan Grice.